The new normal is one of the great calls of the decade. There's Steve Major at HSBC, Gary Schilling with his call on deflation and disinflation. And then there was Gross and Allarian in the new normal. Bill, if you look back over 10 years to the advent of the new normal, now you've got a pandemic overlay. Do we escape your new normal at any point?
Oh, I think we began to escape it, and perhaps we will continue to do so. You know, the new normal was based on a slower economy, lower inflation. It incorporated globalization, to some extent demographics. I think that demographic influence continues. Globalization has actually turned into deglobalization, which is not deflationary but inflationary. So that's been a change outside the pandemic, and of course the pandemic has not helped globalization. It's actually accelerated deglobalization. So to some extent, yes, the virus is changing things rather.
Bill, any number of things to talk about, but I've got to go to your memo today where you talk about a $6 trillion deficit. We've heard this from other sources. The great economist Claudia Sahm has made clear we need much, much more deficit coverage. What does your world do? What does the bond world do if we get out to $3, $4, $5, and $6 trillion deficits?
Well, the bond world at the moment, it is a melding of the Fed and the Treasury. To my way of thinking, this sounds rather derogatory, but the Fed is the dog and the Treasury is wagging it. And to a certain extent, if the Treasury wants money, if they want 4, 5, 6 trillion, then the Fed will provide it through MMT and through purchases, which they've done. Now, do I endorse that? No. Is that a constructive thing down the road? Probably not. Is it inflationary? Probably yes. We'll have to see, but it hasn't been in Japan.
Right.
But to the extent that we've melded fiscal and monetary, and I think rather permanently now, deficits can increase, but gosh, Tom, we're at 100% of GDP already, and it goes to 120, 130, 140, 150, and at some point, as others point out, if the Fed stays out of it or their influence, then inflation is going to come back. And in any case, we've had inflation with financial assets and with commodities, and so it's just come back in another form.
Bill, I remember the day where you recommended the Procter & Gamble dividend and the bond world fell off its collective chair. Now we have permanence of gross financial repression. I'm going to give you great credit for coming up with that concept. Do we have an asset bubble or bubbles plural because we have your financial repression?
Oh, I think so. And we have an asset bubble because interest rates are near zero and negative in many parts of the world. And that, at least to my way of thinking, through dividend discount models and so on, have inflated growth stocks and anything that, have profits far in the future but are growing fast. So yeah, but financial repression, if we want to speak to that, is something that's always been swept under the rug by not only by Powell but by Yellen and Bernanke, et cetera. It's something that can be fixed at a later point because, prior Fed chairpersons have either focused on inflation or focused on, revigorating the economy, and to the extent that that retirees and to the extent that pension funds and savers, so to speak, are being hurt, well, that can just wait. But at some point it can't, and I think we're beginning to see that. I mean, we don't have to talk about Prudential or insurance companies or banks. We can talk about mom and pop on Main Street in Des Moines, Iowa, where they have no more savings and they're not able to earn money on whatever they have left. And, the problem year by year is getting increasingly greater. And I think ultimately that becomes the real chink in the armor of this entire financial complex.
Bill, Jonathan here. always enjoy your writing, and you've never hidden your personality when you do write. I do think, however, today, when people read this investment outlook, the investment calls within it aren't the things that are going to jump out at them. It's the things you write about your family. And I ask you this question, Bill, with a deep amount of respect for your career. What's behind that this morning as you put this out?
Well, I've always wanted to let people know who I am, and to the extent that they know who you are, and there's a certain amount of honesty in talking about yourself and your life, then, to my way of thinking, it always translated into an equal amount of honesty in terms of the investment world. And I think it's always been an autobiographical type of thing. I didn't want to write a book about my life, but to a certain extent, these outlooks, outline my life as I've moved along. And the current one, where I talk about my son's tattoos, I think it's pretty interesting. It's a topical piece of information, not only for my family, but for society. And, to the extent that readers like it, fine. If they don't like it, and some don't, then that's fine too.
Well, Bill, you know that many people are interested in your life. And once again, with a deep amount of respect for the family members that might read this and be terribly upset, you do refer to your son as a disappointment. And I'm trying to understand from you, you look happy right now as we talk, hugely successful. And when people read this, they might just be thinking, Bill sounds really bitter and unhappy. What would you respond to them if they asked you that?
Well, I talked about tattoos. I said he was a disappointment in terms of tattoos, and that, that doesn't mean that he's necessarily a disappointment as a son. I didn't have enough room and space for that. But, I talked about my other two kids as well, relatively tattoo-free, and, just something funny to talk about, especially the tattoo on the inside of my son's lip,
Lisa, the issue here is his son didn't get a 49ers tattoo.
No.
That's the real issue.
And you're going to go get a Tots tattoo. I do want to say, just going back to the investment thesis, Bill, the idea that you were making an analogy of the tattoo on the global economy that can't be removed for a very long time. And you talk about how you expect the bulk of stimulus to have already occurred and that it's time to get more defensive. What does it mean to get defensive with yields so low right now?
Well, a number of things, and yes, I think the tattoo, is applicable to the global economy. A tattoo is a discoloring of the skin, and certainly the global economy has been discolored by the virus, and things have changed in many ways, as you've spoken to, certainly in the past half hour. What does it mean in terms of investments in defensive yield types of investments? I'm always amazed, and I don't discount the phenomena of growth stocks and the FANGs and the big five, as I call them, and others, because, as real interest rates have declined in the U.S. to amazingly on the 5-year to a minus 130 basis points, much more than other countries, then, this dividend discount models would account for that and make growth stocks do much better than, certainly other investments in the U.S. and globally. But in terms of dividends, I'm always amazed that others don't recognize that if you can borrow money at 0 and 1%, and investors can probably borrow it at 2% on margin, then a relatively stable 7 to 8% investment, call it a tobacco stock, or, where I gravitated to some natural gas pipeline stocks with relatively firm dividends. The spread enormous, and if you compound that 6 or 7% a year relative to your borrowing rate, well, that's almost as good as a growth stock, not as good as an Amazon, but pretty good. A stable investor.
Bill, just real quick here, are you saying that leverage is good in this kind of environment given how low rates are?
Oh, for sure. You've got to lever, and to the extent that leverage comes back and snaps you, it does that when central banks raise rates. And of course, I don't think, and others and most don't think, that rates will be raised for a long, long time. So yes, you've got to be able to borrow money. You can do that with closed-end funds that lever. You can do that with, margin at your own account. Whenever you lever, however, you want to do it safely, because as we know, ultimately leverage is destructive and the forerunner of a bear market as opposed to a bull market.